Most people spend 30 or 40 years building their retirement savings. They max out their 401k, they open an IRA, maybe they even put money into a Roth. And then the day finally comes, the day they've been waiting for, and they retire. They feel good, they feel prepared. And then, quietly, without anyone warning them, they start making withdrawals in the wrong order. And over the next 10 to 15 years, that single mistake, that one silent decision, costs them over $100,000 in completely avoidable taxes. Not because they were careless, not because they didn't save enough, but because nobody ever sat them down and explained that in retirement, it's not just about how much money you have, it's about which account you pull from first. And if you get that order wrong, the IRS becomes your largest monthly expense in retirement. Stay with me, because what I'm about to show you could be one of the most important financial conversations you'll ever have. So here's what we're going to cover today. I'm going to walk you through the exact withdrawal order strategy that the wealthiest and most financially secure retirees use to legally keep more of their money and pay dramatically less in taxes. I'm going to show you how pulling from the wrong account at the wrong time can trigger higher Medicare premiums, cause more of your Social Security to get taxed, and potentially push you into a higher tax bracket than you ever were during your working years. And later in this video, I'm going to show you a real-life example, a couple named Tom and Linda, who retired with nearly identical savings to their neighbors, but ended up with over $120,000 more in spendable retirement income simply because of the order in which they made their withdrawals. That's not a typo. Same savings, same Social Security, completely different financial outcome. And I'll break down exactly how they did it. Before we go any further, if you're someone who's within 10 to 15 years of retirement, or you're already retired, and you're trying to figure out how to make your money last longer and your taxes stay lower, this channel is built for you. I'm going to ask you to hit that like button right now because it genuinely helps more people find this information. And honestly, this is the kind of content your financial advisor probably isn't explaining clearly enough. Subscribe if you haven't already. Here on Mr. Retirement, this is exactly what we do. We take complicated retirement finance topics and we break them down so they actually make sense for real people living real lives. Now, let's get into it, because the foundation of everything I'm going to teach you today starts with understanding something that most retirees have never been taught, and that is the concept of tax buckets. Think of your retirement savings not as one big pool of money, but as 3 separate buckets, each one taxed completely differently. The first bucket is your taxable bucket. This is your regular brokerage account, your savings account, maybe some individual stocks. The money in this bucket has already been taxed when you earned it. When you sell investments in this bucket, you typically pay capital gains tax, which for most retirees is either 0% or 15%, depending on your income. That's actually relatively favorable. The second bucket is your tax-deferred bucket. This is your traditional 401k, your traditional IRA, your 403b. The money in here went in before taxes, which felt great while you were working. But here's the catch. Every single dollar you pull out of this bucket in retirement gets taxed as ordinary income. It gets added to your income, just like a paycheck, and it's taxed at your regular income tax rate. For many retirees, that's 22%, sometimes 24% or higher, depending on how much they have saved. The third bucket is your tax-free bucket. This is your Roth IRA, your Roth 401k. Money in this bucket went in after taxes. It grew tax-free, and when you pull it out in retirement, no taxes. 0. None. It doesn't even count as income. Now, here's where it gets critically important. Most retirees have the majority of their savings sitting in that second bucket, the tax-deferred bucket. According to Fidelity's retirement research, the average American has roughly 80 to 85% of their total retirement savings in traditional pre-tax accounts. That means when they retire and start withdrawing money, nearly every dollar they touch is going to get taxed as ordinary income. And that creates a chain reaction of financial problems that most people never see coming until it's too late to do anything about it. Let me explain exactly what that chain reaction looks like, because this is where the story gets really important. When you retire and you start pulling from your traditional IRA or 401k, you're adding that money to your traditional gross income. Now, here's the part that surprises almost everyone. Your Social Security benefits, the money you paid into your entire working life, up to 85% of that can become taxable depending on your combined income. The IRS uses something called your combined income or provisional income to determine how much of your Social Security gets taxed. And that calculation includes your adjusted gross income, your non-taxable interest, and 50% of your Social Security benefit. So if you're pulling large amounts from your traditional IRA every year, you are directly increasing the percentage of your Social Security that gets taxed. What feels like a straightforward withdrawal from your retirement account is actually triggering a double taxation effect. You're paying taxes on the IRA withdrawal, and you're now paying taxes on money you thought was coming to you tax-free. And it doesn't stop there, because once your income rises above certain thresholds, and in 2024, those thresholds are $103,000 for individuals and $206,000 for married couples, you start getting hit with something called IRMAA. That stands for Income-Related Monthly Adjustment Amount, and it's basically a Medicare surcharge. Instead of paying the standard Medicare Part B premium of around $174 a month, you could be paying $244, $349, even $559 a month, depending on how high your income goes. And here's the cruel irony. IRMAA is based on your income from 2 years ago. So a decision you make today about how much to pull from your IRA could increase your Medicare premiums 2 years from now. And by then, most people don't even connect the two events. They just notice their Medicare bill went up and assume it's routine. This is why the withdrawal order matters so much. It's not just about taxes on the money you take out. It's about the cascading, interconnected effect that pulling from the wrong account has on every other source of income and every other bill you pay in retirement. Now I want to tell you about Tom and Linda, because their story is one of the clearest illustrations I've ever seen of what the right withdrawal order actually looks like in practice. Tom and Linda retired at 65, in the same year as their neighbors, Mike and Carol. Both couples had similar savings. Tom and Linda had about $850,000 saved, roughly $650,000 in traditional IRA accounts and $200,000 in a Roth IRA. Mike and Carol had around $900,000, almost all of it in traditional 401k and IRA accounts, with very little in Roth. Both couples were receiving Social Security. Tom brought in about $22,000 a year from Social Security. Linda received about $16,000. Mike and Carol's combined Social Security was close to $41,000 a year. On paper, Mike and Carol actually looked slightly better off. More saved, more Social Security. But what happened over the next 15 years tells a completely different story. Mike and Carol did what felt natural, what most people do without thinking twice. They started pulling from their largest account, which was their traditional IRA. They needed about $75,000 a year to cover their lifestyle, so they took out whatever they needed from the IRA on top of their Social Security. Simple, right? Except here's what that actually meant in terms of taxes. Their Social Security income, plus their IRA withdrawals, pushed their combined income to well over $85,000 a year. At that income level, 85% of their Social Security became taxable. They were paying income tax on roughly $35,000 of Social Security benefits every single year. On top of that, their income exceeded the IRMAA threshold in several years, adding hundreds of dollars in monthly Medicare surcharges. And as their traditional IRA grew smaller, the IRS eventually started requiring them to take out minimum distributions, required minimum distributions, or RMDs, starting at age 73. And those RMDs were calculated based on their account balance, which meant large mandatory withdrawals, whether they needed the money or not. In some years, those RMDs pushed them into the 24% tax bracket, even though they were trying to live modestly. Tom and Linda took a completely different approach, and it wasn't complicated. It was just intentional. In the early years of retirement, between ages 65 and 72, instead of pulling heavily from their traditional IRA, they pulled from a mix of sources. They took their Social Security, they pulled a modest amount from their traditional IRA, just enough to fill up the lower tax brackets, and they used their taxable brokerage account for additional spending needs. And critically, during those early years, they also did something called a Roth conversion. Each year, they moved a carefully calculated amount from their traditional IRA into their Roth IRA, paying taxes on it at their current low rate, sometimes 12%, sometimes 22%, so that money would grow and come out completely tax-free later. They weren't taking more money out of retirement. They were strategically paying taxes at a lower rate now, so they wouldn't be forced to pay taxes at a higher rate later. By the time Tom and Linda hit age 73 and RMDs kicked in, their traditional IRA balance was significantly lower than it would have been otherwise. Their required minimum distributions were smaller, their income stayed in a manageable range, far less of their Social Security was taxed, and they never once triggered an IRMAA surcharge. Their Roth IRA had grown substantially and continued generating tax-free income for the rest of their lives. Over a 15-year retirement period, the tax savings added up to over $120,000. That's not hypothetical savings. That's real money that stayed in their pocket instead of going to the IRS. Now, I want to make sure we're crystal clear on the withdrawal order strategy itself, because I don't want you to walk away from this video with a general idea. I want you to walk away with an actual system. The general rule that most tax-efficient retirement planners follow is this. In the early years of retirement, before you're required to take RMDs, you want to draw from your taxable accounts first, convert from traditional to Roth strategically in the middle, and preserve your Roth for later. But this isn't a rigid formula. It's a framework that you adjust based on your specific situation. Let me walk you through the thinking. When you first retire, especially if you retire before age 70, you may be in a lower income tax bracket than you've been in during your entire career. This is actually a golden window. Your income drops, your tax rate drops, and for a brief period, you have an extraordinary opportunity to move money from high tax territory into low tax or no tax territory. This is the ideal time to evaluate a Roth conversion strategy. You're essentially asking yourself, if I know my tax rate is going to be higher in 10 years because of RMDs, why wouldn't I pay a modest tax rate today and move that money somewhere it will never be taxed again? The math is straightforward. If you have $300,000 in a traditional IRA and you convert $60,000 per year into a Roth over 5 years, you pay taxes on that $60,000 at whatever your current rate is. Let's say that's 22%. You pay $13,200 in tax on that conversion. But that $60,000 then goes into your Roth, grows tax-free for the next 10 to 15 years, and can be withdrawn completely tax-free. If that money doubles to $120,000 in the Roth, you've effectively paid $13,000 to protect $120,000 from future taxes. And you've reduced your traditional IRA balance by $60,000, which means your future RMDs will be smaller, your future income will be lower, and less of your Social Security will be subject to tax. That is a compounding benefit that extends across your entire retirement. But I want to be honest with you about something, because this is where people sometimes get the strategy wrong. Roth conversions are not always the right move for every person in every situation. If you're already in a high tax bracket in early retirement, maybe you have a pension or rental income or a part-time business, then paying 24 or 28% to convert to Roth might not make sense compared to what your future RMD tax rate would actually be. This is where you need to run the actual numbers. And if you don't have a financial planner who is specifically focused on tax-efficient retirement income planning, not just investment management, then this is the kind of analysis you might want to seek out. Because a good tax-aware retirement planner could realistically save you more in taxes over a 20-year retirement than any market gains your portfolio might produce. Let's also talk about required minimum distributions more specifically, because a lot of people don't realize how aggressive these can be until they're already in them. Starting at age 73, and for people born after 1960, the new age is 75, the IRS requires you to start taking money out of your traditional IRA and 401k every year, whether you need it or not. The amount is calculated using your account balance at the end of the previous year divided by a life expectancy factor from the IRS table. And these distributions can be substantial. If you have a traditional IRA worth $1.2 million at age 73, your first RMD could be roughly $43,000. Add that to your Social Security income, and you could very easily find yourself in the 22 or 24% bracket. And then the next year, your remaining balance may have grown, your RMD gets larger, and the cycle continues. By the time you're in your late 70s or early 80s, some retirees find their taxable income is actually higher than it was during most of their working years. That is the RMD trap, and the only real escape from it is to reduce the balance in those pre-tax accounts before the RMDs begin, which again brings us back to strategic Roth conversions and intentional early withdrawals. Now, I want to make something very concrete for you. Let's walk through a simplified retirement income scenario so you can see how this actually flows on paper. Imagine you're 66 years old, recently retired. You have $800,000 in a traditional IRA, $150,000 in a Roth IRA, and about $75,000 in a regular taxable brokerage account. You'll receive $24,000 a year in Social Security. Your living expenses run about $68,000 per year. What's your move? In year one, rather than just pulling $44,000 from your traditional IRA to make up the difference between Social Security and your spending needs, you think more carefully. You take about $25,000 from your traditional IRA, enough to partially fill your lower tax brackets. You pull an additional $15,000 from your taxable brokerage account, money that may be taxed at 0% in capital gains if your income is managed carefully. And you do a Roth conversion on an additional $30,000 from your traditional IRA, bringing your total traditional IRA withdrawal to $55,000 for the year. You pay some tax on that conversion at the 12 or 15% range, but you've just moved $30,000 into permanent tax-free territory. Your total income, including Social Security, hits a level where only a modest portion of Social Security is taxable, and you haven't triggered any IRMAA. You repeat a version of this strategy for the next several years, carefully calibrating how much to convert based on your tax bracket each year. By the time you hit 73 and RMDs begin, your traditional IRA balance has been reduced from $800,000 to perhaps $450,000. Your RMDs will be smaller. Your Roth has grown. Your Social Security tax exposure is manageable. You have more control, more flexibility, and significantly more spendable income than if you'd just done nothing and pulled from the IRA whenever you needed money. I also want to spend a moment on the Social Security timing piece, because it connects directly to everything else we've been talking about. Most people know there's a choice about when to claim Social Security, anywhere from age 62 to 70. But they don't always understand how that timing interacts with their withdrawal strategy. If you claim Social Security early at 62, you get reduced benefits, but you also have less need to pull from your IRA in those early years. Except here's the problem. Those early years, before age 70, are your best opportunity to do Roth conversions at lower tax rates. If you're already taking Social Security income, that's already filling up your lower brackets, which reduces the room you have to do tax-efficient conversions. On the other hand, if you delay Social Security until 70, which increases your benefit by 8% per year for every year after your full retirement age, you might need to draw more from your IRA in those early years just to cover living expenses, which could work against your Roth conversion strategy if you're not careful. This is why retirement planning is never just one decision. It's a system of interconnected decisions that need to be thought through together, not in isolation. The research is actually pretty compelling on Social Security delay for those who can manage the interim income. A study from United Income found that 67% of retirees would have more lifetime wealth if they delayed Social Security until at least 66 or older, and about 57% would have been better off waiting until 70. The break-even point, the age at which you've received more in total benefits by waiting versus claiming early, is typically around age 80 to 82. And given that the average 65-year-old today has roughly a 1 in 4 chance of living past 90, the math on waiting often works out favorably for many people. But again, this has to be evaluated in the context of your health, your spouse's situation, and your other sources of income during the delay period. Let me also talk about what happens if you get this wrong in a more dramatic way, because I think it's important to understand the real downside of ignoring the withdrawal order strategy. Imagine a retiree, let's call him Robert, who retires at 65 with $900,000 in a traditional IRA and $30,000 in a Roth. He claims Social Security immediately at 62, getting about $19,000 a year. He doesn't do any Roth conversions because he doesn't want to pay taxes on money he doesn't absolutely have to take out. He just pulls from his IRA whenever he needs money, taking out $55,000 to $60,000 a year on top of Social Security. His income is consistently around $75,000 to $80,000 a year. At that level, roughly 85% of his Social Security is taxable. He's in the 22% federal bracket. He occasionally dips into IRMAA territory, paying higher Medicare premiums. And then at 73, his RMDs begin. His IRA has actually grown despite his withdrawals because markets were good, and now it's sitting at $1.1 million. His first RMD is approximately $41,000. Add that to his Social Security and any other income, and suddenly his total income is well over $60,000, pushing him firmly into the 22% bracket with some exposure to the 24% bracket. He now has very little flexibility. His Roth is too small to make a meaningful difference. He can't reduce his RMDs because they're mandatory. Every year, a larger and larger portion of his retirement income goes to taxes. By the time he's in his late 70s, he's effectively paying the IRS tens of thousands of dollars that he could have largely avoided with a more thoughtful withdrawal strategy earlier in retirement. This is not a scare story. This is a statistically common retirement experience. According to data from the Employee Benefit Research Institute, a significant number of American retirees end up paying more in taxes during retirement than they expected, precisely because of the RMD effect and the Social Security taxation trap that comes with pulling too heavily from pre-tax accounts. And the tragedy is that for most of these retirees, the window to do something about it was open, sometimes for a decade or more, and they just didn't know it was there. Now, let's talk about what you can actually do, starting today, regardless of where you are in your retirement journey. If you're still 5 to 15 years from retirement, you have the most flexibility of anyone. Start thinking right now about diversifying your tax exposure, not just your investments. If you have access to a Roth 401k at work, consider contributing to it, even if your employer doesn't match the Roth portion. Yes, you'll pay taxes now, but you're building that tax-free bucket intentionally so that in retirement, you have options. Talk to a tax professional, not just an investment advisor, about what your income will likely look like in retirement and whether your current saving strategy is building the right mix of taxable, tax-deferred, and tax-free assets. If you're within 1 to 5 years of retirement, this is the time to get serious about your specific numbers. What will your Social Security income be? What will your RMDs be if you take no action? What tax bracket will you be in? And what's your IRMAA exposure? Run these projections before you retire. And if you have a few good earning years left, consider whether maximizing your Roth contributions, or even doing backdoor Roth contributions if your income is high, makes sense for your situation. If you're already retired, don't assume it's too late. If you're between retirement and age 73, you still have a meaningful window for Roth conversions. Even converting relatively modest amounts each year, $30,000, $40,000, $50,000, and paying taxes at today's rates can make a material difference in your RMD burden and your Social Security tax exposure later. The key is to be intentional and consistent, and to convert only up to the top of a tax bracket that makes sense for you, not so aggressively that you create a tax problem today trying to solve one tomorrow. And if you're already past 73 and taking RMDs, your options are more limited, but not zero. You can explore qualified charitable distributions, QCDs, where you donate directly from your IRA to a charity, which satisfies your RMD requirement without adding to your taxable income. This is an underused strategy that can be incredibly powerful for retirees who are charitably inclined and want to reduce their tax burden simultaneously. You can also look at whether your overall asset allocation still makes sense, whether you're using the right accounts for the right types of investments, and whether there are ways to manage income from year to year to avoid IRMAA and stay within certain tax brackets. I want to step back for a moment and summarize what we've covered, because there's a lot here and I want to make sure the core principles are crystal clear. The three buckets, taxable, tax-deferred, and tax-free, are taxed completely differently, and which one you pull from first determines your tax bill in retirement. Pulling too heavily and too early from your traditional IRA or 401k increases your Social Security taxation, can trigger Medicare IRMAA surcharges, and creates a larger RMD problem down the road. The strategic withdrawal order, using taxable accounts first, doing Roth conversions in the middle years, and preserving Roth for last, is the foundational framework used by tax-efficient retirees who consistently outperform their peers financially, even with similar savings. Social Security timing matters, and it interacts directly with your withdrawal and conversion strategy in ways that need to be planned for together. And the window to make meaningful changes is real, but it is not unlimited. The earlier you act, the more options you have. The difference between Tom and Linda and Mike and Carol wasn't luck. It wasn't that one couple was smarter or more educated. It was that one couple understood the withdrawal order and took it seriously, while the other did what felt natural and intuitive without understanding the consequences. And over 15 years, that difference translated into over $120,000. That's a vacation. That's a grandchild's college fund. That's financial breathing room when you need it most. That's the difference between retirement feeling like freedom and retirement feeling like a constant calculation of what you can and can't afford. Thank you for spending your time here. Make sure you're subscribed so you don't miss what's coming next, because we have some powerful content ahead on Social Security optimization, Medicare strategy, and the most common retirement income mistakes people make in their first 5 years. Until then, take care of yourself, take care of your finances, and remember, a smarter retirement starts with a smarter plan.